Today's episode is sponsored by Land Gorilla, the premier software for managing renovation and construction loans. Let's face it, renovation loans can be messy, but your draw management shouldn't be. Land Gorilla brings draw requests, disbursements, change orders, and project data all into one single experience. The platform eliminates communication gaps so you can deliver faster draws and scale your pipeline safely. Learn more at landgorilla.com. Over the last couple of episodes, we've talked about how renovation financing creates opportunities for borrowers and real estate agents. In this episode, I'd like to complete the picture because contractors often view renovation financing through a completely different lens. Many of them don't immediately see opportunity. They see paperwork, inspections, draws, delays, one more lender asking them to jump through hoops. And I'll be honest, building relationships with contractors wasn't entirely easy for me. A few years ago, I joined a local builders association hoping to build relationships with remodelers. Not long after joining, one of the long-term members gave me a piece of advice I've not forgotten. He told me, don't expect referrals anytime soon. It usually takes about 5 years to earn the trust of the builders and the remodelers. That immediately rang true with me because over a decade earlier, I had joined the same organization, stayed for a year, maybe two, didn't develop very meaningful relationships, didn't receive any referrals, and I didn't renew the membership. I left the Builders Association the first time because I wasn't getting referrals, and now that I look back, I expected relationships to produce results much too quickly. This second time around, I realized trust had to come first, so this time I approached things differently. I kept showing up, I joined committees, I attended meetings, I participated wherever I thought I could contribute, but I did more than just talk about mortgages. I used my professional experiences to help others overcome challenges that they were facing in their businesses, in their field. I listened, really listened, and I learned all kinds of things about the way homes are constructed or how subs work together or how bureaucracy impacted the process. Those things, by the way, helped me tremendously, especially when it came to draw administration. So it was really kind of fun. I learned a lot of new things. Eventually, I was invited to participate on a mortgage panel, and something interesting happened. The discussion became much broader than we expected. We expected to walk in there talking about interest rates or construction loans, but it developed into this conversation about the market, where we were at that time compared to what had happened historically and where we thought we were going to be headed. The builders in the audience, they were relying on our input to make decisions in their businesses. And because only a couple of us at the table could hold our own in that discussion, I quickly earned credibility. My relationships with the association staff deepened, and I earned respect from many of the members. But the referrals, well, those still took nearly 4 years to start coming in. Why? Because builders didn't need another lender. They already had lenders. What they needed was someone they trusted, and I hadn't quite earned that yet. And there was another problem. For years, many of the remodelers told me exactly the same thing. I only work with cash customers. And then the market shifted. Homeowners started struggling to pay cash, and those same remodelers started to ask questions about financing. Together, we created brochures that they could leave behind after quoting projects. We built co-branded landing pages. Some even joined me as guests on my consumer podcast. And the relationships had finally reached a point where we could help each other grow our businesses. And that's really what this episode is about. Not convincing contractors to work with renovation loans, but helping loan officers build relationships that eventually make those conversations possible. Here's my advice. Stop talking about loans. Start talking about closed sales. One of the biggest mistakes loan officers make when they're talking with builders and remodelers is immediately talking about loan programs. I saw it over and over in my involvement with the Builders Association and during other networking events. You'd see a new face at an event and immediately look at their name tag. Oh, it's another lender. Great. Those loan officers would show up for that one meeting, figure out who their targets were, and walk up to them with an immediate pitch. Very rarely did you ever see these guys show up again, and it was really painful to watch. Builders don't wake up wondering how construction loans work, and remodelers don't wake up wondering about loan guidelines. They wake up wondering, how do I sell more projects? That's the conversations loan officers should be having. When I met with contractors, I wasn't interested in giving them my 30-second commercial on renovation loans. I wanted to understand their business. What kind of remodeling do you specialize in? What are your favorite projects to work on? How many jobs do you quote each week? How many actually become signed contracts? And what's the biggest reason homeowners decide not to move forward? The reason was remarkably consistent. They couldn't afford it. And that's where renovation financing begins to change the conversation. One of the simplest ways to explain renovation financing to contractors is this: financing creates customers. A homeowner who can't pay cash isn't exactly saying no, they're saying, I don't have a way to pay for it. Renovation financing gives them another option, and it costs the contractor nothing to offer it. The contractor doesn't have to become a lender, they're not assuming any additional financial risk. They simply gain another tool that can help homeowners move forward with projects that otherwise would never have happened. As a loan officer, try to understand any financing that a contractor, a remodeler, is already offering. One objection you may hear from contractors is, we already offer financing. When you hear that, don't assume the conversation is over. Instead, ask a few questions. What type of financing do you offer? Because in many cases, they're referring to consumer financing, not mortgage financing. Now, I want to be clear, consumer financing absolutely has its place. If someone needs to replace their furnace or their AC unit, maybe install new windows, replace a roof, or some other smaller project, consumer financing could be a terrific solution. It's often fast, convenient, and relatively easy for homeowners to obtain. But it's important to recognize where it begins to fall short. Most contractors I've worked with tell me that those financing programs, they have borrowing limits, maybe a $50,000 cap, maybe $75,000, sometimes less, sometimes more. But those repayment periods are often much shorter than they would be for a mortgage. 6 months, 12 months, 18 months. That means the monthly payments are going to be high. Now think about the homeowner who wants to remodel a kitchen, update a couple of bathrooms, replace flooring throughout the house, finish the basement. Those projects can easily exceed the limits of many consumer financing programs. Even worse, some homeowners might end up financing different projects with different contractors, and then now they've got multiple consumer loans, multiple monthly payments, and a much heavier debt burden than they expected. Renovation financing solves this problem. Instead of several short-term obligations, the improvements are rolled into one mortgage, one monthly payment, often amortized over 30 years. That can dramatically improve affordability for larger projects. Renovation products like FHA 203K or Fannie Mae Homestyle loans are notoriously complex with strict compliance and escrow guidelines. Throughout my career, I've trusted Langarilla because their platform is purposefully built for renovation lending. It handles everything from detailed draw schedules to tracking escrow interest with total accuracy. Don't let compliance slow your business down. Streamline your renovation programs at langarilla.com. Another point worth understanding is this. Several contractors have told me they have to pay a fee to offer consumer financing. Sometimes that's just simply part of doing business. Other times they choose to pay an even higher fee so they can advertise promotional offers like 0% financing. Again, those programs absolutely have their place, but they aren't free to the contractor. Understanding that helps you to have a much better business conversation. Instead of saying you should stop offering consumer financing, you could say maybe there's room for both. Consumer financing can continue to be an excellent solution for smaller projects. Mortgage financing can simply expand the number and the size of projects their customers can afford, and that's a completely different conversation. I've always believed the goal isn't to replace every financing option a contractor already has, it's just to help them recognize situations where mortgage financing becomes the better tool. Here's something else I learned. Many contractors avoid renovation financing altogether. Some think it's too complicated. Others assume that it takes too long to get paid. Some simply don't want to learn a new process. Ironically, this creates opportunity. Contractors who understand renovation financing often find themselves competing against far fewer remodelers. Instead of fighting price wars with their competition, they're offering a solution many of their competitors don't. And here's some food for thought. Guaranteed funds matter. If you've spent much time around contractors, you've probably heard somebody say a homeowner skipped out on their last payment, or they kept changing their mind, or homeowners have been really slow to make payments. Renovation financing changes much of that conversation. Once a loan closes, the renovation funds are already sitting in a renovation escrow account. As the work is completed satisfactorily and draw requirements are met, the money is dispersed. The contractor is going to get paid. That's a level of security many contractors simply don't have on traditional remodeling projects. I mean, who's asking cash clients to show them their bank statements so they can prove they have the money? Here's another benefit I don't think contractors fully appreciate until they've completed a few renovation loans. We all know homeowners change their minds. It happens all the time. Maybe they fall in love with quartz countertops a step above their budget. They want to upgrade flooring or choose different tile or decide they'd rather install solid core doors after all. On a traditional remodeling project, those changes can become uncomfortable conversations. Sometimes the contractor absorbs part of the additional cost just to keep the homeowner happy. Sometimes it creates conflict. Sometimes it affects the contractor's profit on the job. Renovation loans provide a built-in mechanism to help manage those situations. That's one of the purposes of the contingency reserve. Now, I want to be careful here because every loan program has different rules regarding contingency and how those funds, or even if those funds, can be used for discretionary upgrades. But when program guidelines allow it and funds remain available after any unforeseen repairs have been addressed, that reserve can provide flexibility that simply doesn't exist on many traditional remodeling projects. That's another reason loan officers need to understand renovation lending beyond the mortgage itself. You're not just financing a project, you're helping to create a framework that makes projects run more smoothly for everybody involved. When you're talking with contractors, don't just explain the draw process. Explain how renovation financing helps manage the realities of remodeling. Contractors immediately understand that because they live it every day. Another benefit contractors sometimes overlook is cash flow. I'm not suggesting that renovation financing eliminates the need for builder lines of credit. It doesn't, but it can reduce their dependence on them. Knowing that the renovation funds have already been allocated gives contractors greater confidence when they're purchasing materials, when they're scheduling their subs, when they're managing larger projects. And the project has to be finished. That's another difference contractors appreciate. Once the renovation loan closes, the project isn't optional anymore. The homeowner can't suddenly decide they'd rather spend those funds on a vacation or a new car. The improvements are part of their mortgage transaction. The work has to be completed, and that creates stability both for the homeowner and the contractor. These projects can also help contractors or remodelers build relationships that create more business. One of the biggest surprises for many contractors isn't necessarily the financing, it's the relationships. Successful renovation contractors naturally begin meeting real estate agents, loan officers, consultants, specialized inspectors, draw administrators, appraisers. Those relationships frequently add to additional referrals. It doesn't happen overnight, just like my experience at the Builders Association. Trust takes time. Here's a pause and think moment, something I'd encourage every loan officer listening to consider. When you meet with a contractor, are you trying to explain renovation financing? Or are you helping them to recognize opportunities they might otherwise overlook? Because contractors don't need another lender, not usually. They need someone who understands their business. And when you take time to understand their business, they become much more interested in understanding yours. I'd like to invite some listener engagement. I'd love to hear from you. Have you developed a strong referral relationship with a contractor or remodeler? How did it begin? What lessons have you learned? Or maybe you're the contractor listening to this podcast. What do you wish more loan officers understood about your business? Send me your questions, your success stories, future topic ideas. You can email those to jennifer@renogal.com or leave me a voicemail at 844-RENO GAL. Follow the prompts. Your story may inspire a future episode. In closing, borrowers often think renovation financing is about paying for repairs. Real estate agents often think about it as selling difficult houses. Contractors often think about it as additional paperwork. But in reality, we are creating opportunities for homeowners to move forward with projects they couldn't otherwise afford, opportunities for real estate agents to solve problems and grow their business, and opportunities for contractors to take on more jobs, build stronger referral relationships, and spend more time doing what they do best. When loan officers understand that and learn how to communicate it, they stop being viewed as another lender, and they start becoming trusted business partners. In the next episode, we're going to talk about one of the simplest and most overlooked opportunities that loan officers have to educate borrowers and referral partners. I'll walk you through what I included alongside my pre-approval letters, how I tailored that information to different situations, and why that became one of my most effective ways to set expectations before the loan process even began. Thank you for spending a part of your day with me. This is renovatED for Lenders. Thank you for listening to renovatED for Lenders. This episode was brought to you by Land Gorilla. Deliver clarity to borrowers, contractors, and your operations team with the industry's most trusted draw management solutions. Visit landgorilla.com today.